what actually happens there is your dividend yield would increase because as they continue to add to the dividends that they're giving out on a yearly basis. And that's one way for you to be able to grow what you have over a stretched period of time. Number two is focus on dividend yield and growth. Consider both the current dividend yield and the potential for the future dividend growth. Look for companies with higher dividend yields that are sustainable and supported by strong financials. Hey guys, so in this video, I want to talk about how you can double your money via dividend investing and how you can actually make it grow. When people talk about dividend investing, they would always say that, oh, dividend investing is just a passive way to invest. It's kind of true also because I would talk about dividend investing in a way that you could use it to get passive income for life. You can use it also that as you start earning from it, you can use the cash flow that you get from it to be able to live. However, in this video, I just want to give you a playbook, a strategy on how you can actually be a dividend investor, but still have the chance and have a shot to make your money grow in spite of you just focusing on dividend stocks. And please do note this, that it doesn't mean that if you're investing in dividend stocks that it won't grow anymore. Since you're invested in the stock market via dividend stocks or even if it's via REITs, there's capital appreciation. Do remember that it goes up via supply and demand. More buyers bring the prices up, more sellers bring the prices down. In spite of you having a dividend stock that goes up, it's also subjected to supply and demand and could give you capital appreciation as well. So first things first in our playbook is that I want you to research and select dividend-paying companies. Start by researching and identifying companies that consistently pay dividends. Look for companies with a track record of increasing dividend payouts over time, as this indicates stability and growth potential. So number one, it has to be companies that are consistently paying dividends, regardless if it's yearly, quarterly, or semi-annually. In the Philippines, you have a lot of that, from PLDT to Globe to Meralco, and a lot of the dividend stocks that I would mention and show in my videos as well. You can also get that also via REITs, but it's very, very important they're consistent. The dividend payout should be increasing over time. It shows that the company is very healthy. It shows that the company also is growing. It shows that what you buy now, even for example, you buy something with a dividend yield of 5% now, but because the company is growing, maybe if you just put in one time, what actually happens there is your dividend yield would increase because as they continue to add to the dividends that they're giving out on a yearly basis. And that's one way for you to be able to grow what you have over a stretched period of time. Number two is focus on dividend yield and growth. Consider both the current dividend yield and the potential for the future dividend growth. Look for companies with higher dividend yields that are sustainable and supported by strong financials. Additionally, analyze the company's history of increasing dividends, as this can boost your total return on investment. So it's not so hard. You can just go to brokerages and platforms, and you can go to the research tab and look at the dividend history of the companies. Of course, this may take time, but nothing of significance, nothing that will give you wealth that's sustainable is easy. This is something that you also have to spend time to be able to research and find out what works for you and what filters out for you as well. But it's very, very true that you need to set a dividend yield that's acceptable to you. Some are okay with 4%. I normally set it at 5%. The higher it is for 5%, the better it is for me as well. And it allows you also to do some balancing acts. What do I mean by that? The dividend yield right now, by the time we're recording this, of PLDT, somewhere around the 9% mark. The dividend yield of Meralco right now is below 5%. And if my rule is I want something above 5%, then Meralco won't cut it for me. But if I buy PLDT and Meralco together, the high dividend yield of PLDT somehow balances off. That's how you could actually mix it also together. But very, very important that aside from having a track record of increasing their dividends, it should go back to the fact that the financials of the company should be very, very good. At the end of the day, when you start investing in the stock market, you are investing in companies, and its health, how they earn, and how they have shown it in the past will play a very, very big role in how your money will be also. Number three is diversify your portfolio. Build a diversified portfolio of dividend stocks across various industries. This helps spread the risk and increase the chances of having a successful dividend portfolio. Avoid putting all your eggs in one basket and diversify across different companies and sectors. So if you look at PLDT and Globe, they give you high dividend yields. However, it would be good also to have and to be spread across, like Meralco, which is highly connected to energy distribution, and then REITs. So REITs are very, very attractive in giving steady cash flow. However, if everything that you're buying are REITs, then you are also subjecting yourself to exposure to one particular industry, one particular segment. It would be highly responsible if you diversify and you put in your money also into other companies that give you dividends. That's why it's interesting also to look at GMA7, because GMA7 is not connected to what Globe is doing, what Meralco is doing, and it's also not connected to what REITs are actually doing as well. So if you find other companies that are doing other things, and even if their dividend yield may not be as attractive, then it should be very okay for you. Number 4, and this is one thing that I hope you remember, and this is one of the biggest things that you want to get if you want to double your money via dividend investing. Number 4 is consider reinvesting the dividends you receive back into the same stocks or other dividend-paying investments. This strategy is known as dividend reinvestment. It allows you to benefit from compounding returns and potentially accelerate the growth of your investment. When you take the money out that you get from dividends, you remove the potential for money to work hard for you. So the way for you to build wealth is not just in how much you get percentage-wise from what you earn, but what you do with what you earn, how you reinvest it. And if you want your money to compound, you want your money to work harder for you, whatever you get from dividend investing, you reinvest it and you pile that back in. Number 5 is this, and you have to monitor and adjust. You need to regularly review the performance of your dividend stocks and make adjustments as necessary. Keep track of dividend announcements, company news, and the overall market conditions that may affect the dividend-paying companies in your portfolio. Stay informed and be prepared to make informed decisions based on changing market dynamics. One example, SPC, they were giving dividends high prior to 2020, 2019, 2018, 2017. Their dividend yields were very, very high. Then it started to dip because they started to use the money more, use the things. You don't have to buy them anymore. And there can be a decision also that if you own them and you have another dividend stock that will give you a better result, then it might be better maybe to take profits on SPC and transfer it to another stock that will give you a higher yield as well. And in the same way also, REIT, also for those who are looking at it from a REIT perspective, the dividends that REIT have given, they've slashed it. You don't have to buy everything, or if you have bought it, you don't have to buy it again. You don't have to double down on something that's not working for you as well. Number 6 is this, a long-term perspective. Investing in dividend stocks is generally a long-term strategy. It's important to have a patient and disciplined approach, as the compounding effect of reinvested dividends can have significant results over a period of time. Avoid reacting to short-term market fluctuations and focus on underlying fundamentals of companies you've invested in. Remember, investing involves risk, and it's important to conduct thorough research and to consider your own risk tolerance when you start investing. It's quite different from the perspective of trading, that you buy low, sell high, use 15-minute candlesticks for you to be able to make decisions on your trades. That's you earning from the volatility. Here, you have to be patient and disciplined in a way that wait for the dividends to come in. If it's still a good company, hold on to it. As the dividends come in, reinvest it in the company that you believe in. So that's how you double your money via dividend investing. It's by researching and selecting dividend-paying companies. It's about focusing on dividend yield and growth. It's about diversifying your portfolio. It's about reinvesting the dividends. It's about monitoring and adjusting it. And lastly, having a long-term perspective. If you want to know more about dividend investing, check out the links down below for the books that I've written, for the seminars that I have, and the hundreds of videos that we have about the stock market. So I hope you guys got a lot from this. This is Marvin Kermo. I hope this video helps you trade well, trade strong, trade smart. See you all again soon, and God bless you all.